My name is Michele Fourie. I'm a senior specialist at the AML CFT Supervision Department in the Conduct of Business Supervision Division in the Financial Sector Conduct Authority. And we are here to deliver another sterling webinar for your viewing pleasure today. I am not on my own because that would just be lonely. I'll hand over to my colleague who's going to help us with the webinar today to introduce herself.
Good afternoon, everybody. My name is Mpho Radebe, and I'm the manager in the AML CFT Supervision Department. Thanks for joining us this afternoon.
Thank you, Mpho. So what are you and I going to discuss this afternoon? For the viewing and learning pleasure of our viewers, we are going to look at understanding money laundering, terror financing, and proliferation financing risk. How are we going to do that? We're going to tackle it through looking at conducting a business risk assessment, all the ins and outs of a risk management and compliance program, and then, of course, some related inspection findings to make this a bit more practical.
Michele, how would we describe the concept of risk in line with the guidance provided under Guidance Note 7?
Yes, Mpho, so Guidance Note 7 is a very popular guidance that was published by the Financial Intelligence Center. I think it's become quite the cornerstone of helping institutions and even us as supervisors understand exactly what the FIC Act requires us to do. With reference to our discussion today specifically, I thought we would single out what Guidance Note 7 is saying about risk. So we are talking about specifically, as we said, money laundering, terror financing, proliferation financing risk. And for purposes of the discussion, I think we'll abbreviate it. We'll call it MLTF-PF risk. And what Guidance Note 7 basically says is that risk, your MLTF-PF risk, it refers to the likelihood and the impact of uncertain events on set objectives. The impact can be a positive or negative deviation from what is expected, and now this uncertainty is then a function of three factors. And those three factors that we would quickly like to unpack as a refresher is, first of all, what is a threat? A threat is essentially a person. It could also be a group of people. It could be an object or an activity that has the potential to cause harm. So in our discussion today, the context, this includes criminals, for example, or terrorist groups and their facilitators or their funds, as well as the past, present, and future MLTF-PF activities. So that is what a threat is. A vulnerability comprises those things that can be exploited, so abused by the threat, and that may support or facilitate the activity. So identifying vulnerabilities distinct from threats really means focusing on, as an example, those factors that represent weaknesses. So where can a threat take advantage of that vulnerability? Where is a weakness? And that exploitation is then essentially the vulnerability. Now, the consequence is where your threat and your vulnerability comes together. It's really the impact of a threat or the exploitation of a vulnerability. So how likely, if this materializes, this threat having taken advantage of a vulnerability and it materializes, what does that consequence look like? So essentially, we're looking at the likelihood and the impact of MLTF-PF activities as and when they materialize as a result of that combination of your threat and your vulnerability that is manifesting in an accountable institution.
And Michele, is there a difference in the nature of the risk once it is treated?
Definitely. So there's another distinction that is drawn in Guidance Note 7 that helps us clearly understand there's a difference between an inherent risk. So that inherent risk is a risk that is inherently there. It can't be wished away. But if it is identified and treated with the appropriate controls, that risk can be mitigated, which gives us essentially the residual day-to-day risk. that the institution, our viewers, are prepared to live with. So this essentially our talk and discussion about risk. I think it's good that we emphasize that we have moved away from a rules-based approach. Many years ago, in fact, in 2017 already, it's 2024 now, we are applying a risk-based approach when we're carrying out our customer due diligence measures. And the risk-based approach means that there's flexibility or discretion on the side of the viewer, our accountable institutions, once they have identified the risks and applied appropriate controls to make sure that the controls that they elect to apply to a particular risk to treat it is in fact commensurate with the risk. That means essentially accountable institutions really should avoid treating all risk the same because they're not the same. And all controls applied might not be evenly effective when there is a differentiation in the risk factor. So that treatment must be commensurate with the risks identified. So our viewers should determine in the risk assessment processes that we'll be discussing today what weight they actually assign to risks they have identified. And this is informed both by a national and sectoral level in terms of risk assessments conducted on those levels. And all the sources of information on risk indicators, another thing we'll be touching on today, as well as the processes, should be incorporated in the consideration and then reflected ultimately in what is called the Risk Management and Compliance Program. And for the benefit of our viewers today, again, we're going to abbreviate and refer to that as an RMCP. So that basically constitutes the difference, Mpho, between an inherent risk and a residual or a treated risk. So now we have a little bit of a refresher, a clear understanding again about what is a risk, a threat, a vulnerability, a consequence, the distinction between inherent and residual risks. From your side, are there any specific factors or risk factors now that our viewers should be focusing on in line with getting to the point where I can say, I understand my money laundering, terror financing, proliferation financing risk?
Yes, Michelle, definitely there is. As mentioned earlier, Guidance Note 7 has made provision for a number of factors that all accountable institutions need to consider or assess their vulnerability or the threat in relation to AML TFPF risk. And I'd like our viewers to please understand that these factors are not exhaustive. Institutions have got the flexibility of identifying other factors that would assist them in order to identify and assess that inherent risk. Obviously, take into account their business operation or in terms of how they are operating their business. So, number one, our viewers need to appreciate that institutions do have different types of clients. So when you assessing a type of client, you need to keep in mind the ML or TFPF risk. A certain type of client might present your institution with ML, TF, or with PF. So for example, types of clients, we're speaking to natural persons, individuals. We can speak to a type of a client that's a legal entity. Of late, what we're seeing, we have pension funds as clients, we have churches as clients. So each and every institution, in order to show that they do understand or they have assessed their type of clients, will need to touch on each and every type of client that they have on their books or whom they want to take on as clients. Similarly, products and services, some institutions are not marketing or distributing products, but services could be one of the channel, or not channel as such, but they could be offering their clients services. So it's not, how can I put it? So if your institution is rendering a service and not necessarily providing a product or advising or recommending a product, we need to see how you have assessed that service for ML TFPF risk that we are discussing today. Some products as well would pose a higher risk or would have an inherent risk in ML as opposed to PF, or alternatively TF as opposed to PF. So when institutions, accountable institutions, have to have that at the back of their mind when we asking them, or when they're asking themselves, my products or my services, what is the ML TFPF risk / vulnerability / threat? Similarly, delivery channels as well. Institutions have to look at how they are distributing or how they are reaching out their customers. In what manner? Delivery channels, it can be an example of a face-to-face where the engagement is with the client in front of you. It can be through a platform where the client is not in front of you, but the client is yours. You still have to assess how vulnerable is that channel in relation to MLTF or PF risk. Geographic locations as well. I think it's important to sensitize our viewers that when we speak of geographic locations, we're not speaking of where the entity is operating. It is wider than that. The entities might be operating Gauteng, however, their clientele are based outside of Gauteng. And those areas, they could present a different risk to Gauteng. So another example that I'd like to make, Michele, where I've seen some institutions take into account other factors than the minimum that has been highlighted in Guidance Note 7. Some are taking into account adverse media, to what extent they're using adverse media in order to understand their risk exposure as an entity. Some, the use of cash, whether it is their modus operandi to deal in cash or not. So indeed, institutions must think out of the box with the aim of mitigating, if not elimination, of MLTFPF risk, so that they don't, or their institutions is not used or susceptible for MLTFPF. So an accountable institution, to accurately identify these factors in an assessment, it is necessary that the institution have a holistic view of information gathered about its client across all points of engagement. This implies that institution where it offers a range of products or services, it should consider the different engagements with a particular client. And maybe also, I'll touch on it a bit later, just to say that at a point in time in year one, when you onboard the client might be low risk. However, in accordance with evolving engagement with the client after a year might not necessarily be low risk in relation to MLTFPF. So it's a holistic, institutions need to understand that this, from an entity, from the macro level, entity understand the vulnerability, understand the threat of MLTFPF that could somehow find itself being realized, or your institution being part of the financing of terrorism or laundering of money.
Excellent, Mpho. So now this brings us really to the big question. I think it's a burning question in the mind of many a viewer of conducting a business risk assessment. RMCPs, people might be much more au fait and familiar with by now, but that's why we wanted to tackle this topic with our viewers today. So conducting a business risk assessment, what it is, have you picked up anything maybe from the Financial Action Task Force side that can help guide our viewers on what this is and how to do it?
Yes, so from the fact of the guidance is that in assessing MLTFPF risk, accountable institutions must determine how the identified threat will affect them. Certainly, I don't think it would make sense for an institution to identify a threat and not necessarily give a reason why that threat will materialize or will affect them. So it's important, ML, TF, PF risks that have been identified by institutions, they have to also outline how these threats will affect them. And obviously, information obtained, it requires to be analyzed and to understand, with a view of understanding the likelihood that these threats would occur or these risks would occur, and the impact that it would have on the accountable institution or pose to the accountable institution if the threat or the risk is realized. So with that at the back of our accountable institutions' mind, it just needs to be there, where they've identified a threat, they've identified a risk, and the likelihood is high for it to occur, and the impact would be disastrous. Obviously, then the assessment of that threat or that risk would be high. And then risks are often classified or categorized as this is a low risk or a medium risk. Of late, what we're seeing is institutions have said this is low risk, this is low medium risk, this is medium high. Obviously, those are the combinations. So long as it's clear to the supervisor and the reader of the business risk assessment to understand what is the difference between low and low, or low, medium, and medium. So it needs to be outlined in that business risk assessment. So to classify the risks as either low, medium, or high, we're doing that in order or institutions should be doing that in order to understand and prioritize the risk. The higher the risk, the higher the priority, and obviously the measures taken to address that risk will be more stringent than lower risk. And maybe just to round this topic off as well, a business risk assessment goes beyond than a mere collection of quantitative or qualitative information. It is the basis of how you should be understanding your risk in order to mitigate it. And something to keep in mind, Michele, it must be reviewed and kept up to date to remain relevant. A business risk assessment that was conducted 10 years ago might be relevant on this day when we come and inspect an accountable institution.
So maybe just to share with our viewers an example. You touched on this guidance from the FATF, the Financial Action Task Force, and that was actually the same source where we took this extract from. It is a limited extract. And yes, that particular guidance was focused on the life insurance sector, but the principles are really the same. And all we're trying to do, Mpho, is to show the viewers, that you talked about you have to go beyond. You have to get the correct information to help you understand your risk and when you assess it. So those risk factors that you were talking about, the clients, the product services, the distribution channel, the geographic location, those are all reflected in this example. And again, this is not exhaustive. This is a tiny extract from the example. But when you look at, for example, clients, so when I'm an accountable institution, I'm busy with my business risk assessment. I'm looking at the factor of clients. I could be thinking of things like my client base growth. Why? Because could it be that the rapid growth or turnover of a client base in terms of your amount or client diversity, could that be not pushing up your risk related to a client? Another factor related to clients could be how easy or difficult it is to identify a client. So imagine you have a person acting on behalf of a client. There's a gap or some distance between the accountable institution and the customer. Does it make it a bit more difficult to identify and verify the identity of that client? And how would that speak to my understanding of the risk when I assess it? A last example related to clients is when you deal with structures, complex structures, corporate veils, beneficial ownership. These could all hamper efforts or make it more difficult to maybe get to the answer, who is the beneficial owner? And that complexity should be filtered into my assessment of client risk. Going to products and services, the characteristics, the features of a product. You know, products are all built in a certain way to deliver certain outcomes, I suppose. Financial benefits essentially for the customer. So you do have some products that's maybe associated with high risk payments. The characteristic of it would be that it's designed for the accumulation of large funds or allow a large transaction. That characteristic should filter into the assessment. You could similarly have other characteristics such as payment to third parties allowed, or cash components, or cooling off periods. All of those can filter and should filter into the business risk assessment as it relates to this risk factor of products and services. We have distribution channels. So when you and I meet face to face, we can see exactly your Mpho, I'm Michele. And that doesn't mean that when we talk over the phone that we maybe know each other less. But if we've never met and we just talk on a social media, for example, if that is how I sell or offer my financial product and service, that could impact the risk. It doesn't mean the other channels are illegal, but certainly it could push up the risk, which means that commensuration of the controls applied to treat it should deserve some attention. And with geographic locations, again, you've touched on this. The products and services, is the viewer offering that in a high-risk country? What is a high-risk country? It could be a blacklisted country, it could be a grey-listed country where enhanced monitoring is required. Where does my client reside? Often that's unfortunately where the assessment stops. There's just a mere distinction between foreign and local, but we're not looking at the impact of other factors in the local environment, such as borders or metros or things like that. So where your client resides, it has an impact, and it requires some granularity. Again, what you mentioned of going beyond. And lastly, if I'm an institution who have intermediaries selling and offering my product, or I have maybe juristic representatives, are they based in higher risk jurisdictions, especially if I offer the service cross-border? Hey? Those are all examples, non-exhaustive, encouraging our viewers to go and have a look at this, this paper published by the Financial Action Task Force. If you haven't done a business risk assessment yet and you're not sure where to start, this might be helpful. So in this vein, but before we now get to the actual details of risk management and compliance programs and so on, I think it would be good. They say, you know, repetition helps with comprehension. Certainly does for me. So if you could maybe just take us high level again, summarize what we've learned so far. Thanks.
Thanks, Michele. So in terms of risk assessment, I think what we've said so far, it was quite clear that the assessment of risk should be commensurate to the nature, the size, and the complexity of the business. We've come across RMCPs where really when you look at this RMCP, it's not speaking to the nature and the complexity of this institution. And I guess we'll touch on it a bit later, where templates and non-customization of these templates is not made. And as a result, then you start to ask yourself, this risk assessment, it's not speaking to the operations of this accountable institution. And then another thing that we've touched on is that there should be a clear methodology of how institutions have assessed their risk, the rationale. Why are you saying that this type of a risk is low? Why are you saying that this type of risk is high? Michele, you've mentioned also the weightings where one would need to assign weight to the risk that is identified, which will also somehow link with the client risk assessment, which is the risk matrix, which we'll touch on a bit later. But indeed, a clear, definitive methodology that me as an outsider who's coming to inspect and see if indeed the institution is carrying out what it's provided for in its business risk assessment, I should be able to understand. It must be clear. The risk assessments are not a once-off thing. They need to be reviewed frequently in line with what's happening out there in the market, what the supervisors or competent authorities have put out as emerging or typologies or guidelines. So I certainly don't think that it will fly if an accountable institution is relying on old, outdated typologies, whereas information that is upcoming new is out there and has been put out for institutions to consume. And then they should be reviewed promptly as well. It doesn't help to review your risk assessment 6 months after. Already you might find yourself on being exposed, and you've taken some time to come and review your risk assessments. And it can be a number of things, internal factors as well. Something to mention, which is now on the slide, can be a launch of a new product. It doesn't help that your risk assessment has taken into account your previous 2 products, but then in the meantime, in the last 2 years, you've added 3 or 4 products or services, but then your business risk assessment does not evidence that. So I think that's something that we touched on, and I think it's important. Our institutions need to really put their fingers on the button. There are other external factors as well. Regulatory changes, legislative changes, sector risk assessments that can bring out a new information that the institution, most probably the time when they conducted their business risk assessment previously, did not take into account. So obviously, not only internally but externally as well, to inform whether your risk assessment is relevant, correct, and will assist you to combat MLTFPF.
Absolutely, Mpho.
Thanks, Michele.
So we're moving now to what we said we believe our viewers should be fairly familiar with. Risk management and compliance programs, we call it RMCPs. Not just serving as a refresher, we've picked up concerns with regards to business risk assessments and RMCPs, and that's why we're tackling this again today. So in terms of the Financial Intelligence Center Act, which has been amended by the General Laws Amendment Act of 2022, there is an obligation on all accountable institutions to develop, document, maintain, implement a program to counter money laundering, proliferation financing, and terrorist financing. And this program must enable the institution to identify, assess, monitor, mitigate, and manage all the risks that could come as a result of them providing new and existing products and services, as it may involve facilitation of MLTFPF and related activities. And I think what's very important here is this again speaks to the fact that it's not just related to what I did a year or 2 or 3 ago, but certainly where there's an expansion of my products, my client base or something, this program must cover, emphasizing again what you said about, reviewing and doing so frequently. So it's clear in terms of the legislation, the fact that there is this obligation, you must have a risk management compliance program. Sometimes people find reading legislation a bit difficult. So to help there, do you have any some useful tips for them that maybe could assess or assist them and soften the blow a bit so that it doesn't come across as such a big job. Yeah, over to you.
Thanks, Michelle. Yeah, look, I do have some useful tips in developing an RMCP, but I must emphasize that performing or conducting a business risk assessment is the foundation towards developing the rest, well, your RMCP as a whole. So first and foremost, that business risk assessment and understanding there is important, and thereafter you need to start to document your RMCP. The number one, I think I've touched on it as well, that our institutions need to familiarize themselves with external factors with regards to risk assessment. I think I mentioned sectoral risk. But don't just limit yourself to the sectoral risk as well. It's important to understand the impact of MLTFPF in our country. So I think it's important to start with the national risk assessment and then go down to your sector risk assessment. FSCA, we have published our sector risk assessment, sectors being FSPs and CIS managers, and then we have authorized users of an exchange. So your just as a tip as well, be familiar with the sector risk assessment so that you know and use it as a basis to start off with your own business risk assessment. Obviously, what has been mentioned, or not obvious as such, but what could be mentioned in the sector risk assessment as threats or as risk within the sector might not necessarily be applicable to your business, all of it, but somehow your institution is not operating outside of the sector. It is within the sector, and as a result, you need to make yourself familiar with the sector risk assessment. The customization of RMCPs, please, the request we are imploring on our FSPs, accountable institutions, to please customize that RMCP. You might be broker A, operating and in your area, maybe let me leave the area, broker A, broker B, broker C, but you might not be using the same processes and have the same controls. So for an outsider or a new employee, when they take your RMCP, they should be able to know exactly what has been approved by the governance structures and know what to do without necessarily that much intervention from management on their end, but be able to see what is expected of them from that RMCP. Customization is very important. And whilst I'm still on that customization, which probably might be, I'm now hampering on our last point, Michelle, the how part, how you are going to ensure that you are not conducting a business relationship or concluding a single transaction with an anonymous client needs to come out. The other tip, which I saw it somehow lacking in these RMCPs, is that the background on the nature of the business of an accountable institution is lacking in there. Some do have, but really once you start to interrogate in terms of what you're finding in the client files, and you go back to the RMCP in terms of background, you can see that some of the information has been omitted. So it should serve as a reminder as well to yourself to say that as an accountable institution, this is my operation, this is my nature, this is the background of my business, this is what I'm doing. And as a result, have I ticked all the boxes in relation to the vulnerability of my entity for exposure to or to being used for MLTFPF. The governance structure as well is important to also outline who does what at what point, who develops what, who approves what, so that it's not left to interpretation or assumption that because this RMCP was developed by the compliance officer, the compliance officer therefore can sign it off. Please clarify exactly what your processes internally are, keeping in mind that under governance obligation, the certain structures, governance structures that have got the obligation to ensure compliance with the FIC Act or with the RMCP. I think we touched on a lot about rationale. Why are you saying this is a risk? How that risk will materialize, or how it could materialize if somehow you became vulnerable due to maybe lack of controls. And please, there's no such a thing as no risk. There is a level of risk. It might be minimal, but there is no risk. So even if in your business risk assessment, your type of clients, your products, your services, geographical areas, you deem them to be low risk, you still have to implement that RMCP. You can't just leave it as saying the products that I'm distributing and my clients are low risk, and you leave it at that. I think I have labored enough on giving a reason why are you saying they are low, or the product is low for money laundering, or the product is low for TF or PF or the clientele. So Michele, I think then those are some of the tips that I can share with our viewers.
And I'm sure they appreciate that. Mpho, so business risk assessment, preparing a risk management compliance program. We've seen matrices. People talk about the risk matrix, risk writing your client. What is the purpose of a risk matrix? What is a risk matrix? What is it supposed to do?
So a matrix or a risk matrix, it's supposed to assist the institution to risk rate the client. Now, risk rating of a client, I'll use it interchangeably with client risk assessment. The factors that are going to be used to risk rate a client or to risk assess a client have to be informed by the business risk assessment. So in the absence of business risk assessment, the question that one would ask themselves would be, now, where does this factors emanate from? Because then we might have failed to see where the business risk assessment, or we might have not been given evidence of conducting such a business risk assessment. And like I said, your client risk assessment is informed by your business risk assessment. And here it speaks directly to the client. You've got different types of clients, but when you are risk rating a natural person client who's a foreigner or politically exposed person, obviously the risk rating of that client will not be the same as for any other natural person clients. Further to that, what I wanted to also share was that your client risk assessment is informed by your business risk assessment. Business risk assessment would need somehow to be informed by that sector risk assessment that I mentioned earlier, because your entity is not operating in a vacuum; it's operating in a sector. So it's very important. This is also dealt with in Guidance Note 7, where it's stipulated that the extent that all the factors that are relevant to the engagement of a client are drawn together in that risk matrix. Type of client, product that the client has taken up or is going to take up, or the service that you're going to render, where the client is located, or where your product is now going to end up, the interaction that you are having with a client, that will culminate into some form of a rating of your client to come out and say, my client is low risk, my client is high risk for ML or TF or PF. So from your experience, Michele, having shared that, what should our viewers try to avoid when they are developing their own RMCPs?
Yeah, and I think we always come across as we tell people what to do, but maybe it will be more helpful if you tell people what not to do sometimes, because we're human beings. and we all have like default systems that's comfort zones for us. So if this would be helpful at all to our viewers, procrastination is something to avoid. We like as especially South Africans to do things on number 99. We crave that pressure, but it's unnecessary to bring that burden of pressure on yourself as an accountable institution. It takes quite a bit of effort to conduct the business risk assessment, to actually understand the risks, and then to roll that into your RMCP and develop the controls, to go and implement it, review it, see whether it's working. And then it becomes a live process in any case that's ongoing. So to procrastinate because you feel overwhelmed or you don't know where to start, it's going to cause you more pain going forward. So avoid procrastination. You've touched on it, using templates without customization. There's nothing wrong with looking at a template. If you really don't know, you're sitting with a blank page and you're sitting with a pen, but you don't know where to start, what it should look like. Look at templates, maybe they will be helpful, but if you just default to just slapping your name on a template that you got from any number of places, maybe it's your neighbor's RMCP that you just scratch out their name with Tipex and put your name on, that is not going to be helpful to you. Having an RMCP is not a tick box exercise. And if you have a document just for the sake of it so that you can show the FSCA, or that's not going to help you to identify your risks and to mitigate them at all. So avoid not customizing your RMCP if you opt to use a template to help you as a starting point. Then avoid a misalignment between the processes you've prescribed for yourself in your RMCP and what you actually do on a daily basis. And that goes for your staff as well. So you might have wonderful processes in your RMCP, but you go and do something absolutely opposite. Then you're not even subscribing to your own prescribed processes. And that would be a red flag, definitely. And it could be that your processes that you practice on a daily basis have evolved to such an extent that they are in fact more effective. But now your review of your RMCP hasn't kept up. Those two should be the same coin, essentially. So avoid that misalignment. And that actually comes from also failure to review, both in terms of your risks as well as your controls. That is often where that misalignment starts. So those are some recommendations for our viewers to consider, if that is appropriate. And then, of course, it's always helpful Mpho to deal with some practical information, real life information, not just the theory of you should do this, you shouldn't do this. A lot of guidance has been published in this regard, a lot of discussions, webinars, conferences, but still, when you conduct supervisory interventions, inspections, you have certain trends that are surfacing. So don't you want to share with our viewers what those trends are so they can maybe not step into the same potholes when we come knocking on their door? So over to you.
Thanks, Michele. I think just hot off the topic, our findings also when we're doing these inspections is the absence of or lack of evidence of conducting a business risk assessment. In a lot of our inspections, what we are presented with, it's a client risk assessment, which has no foundation. Foundation meaning as in being informed by a business risk assessment. So if there is a business risk assessment that has been attempted, we find that it's not always adequate. Adequate how? In relation to the type of clients that the institution has, or in relation to the products that the institution is probably marketing or distributing or services. In relation to geographical areas where the clients are residing or where the products end up being consumed or the delivery channel. So you'll find a half job, if a job, if I can call it that, it's a job, but more prevalent of late. It's the missing assessment in relation to proliferation financing. And maybe it might be because our institutions are not really familiar with proliferation financing. But of course, you mentioned that with the General Laws Amendment that came into effect in December 2022, we introduced, or there was an introduction to proliferation financing to combat it. So our institutions probably might be a bit misinformed with regards to proliferation financing, which we should not let our institutions to be used to finance proliferation activities. And then the other issue is RMCPs that are not compliant with Section 42 of the FIC Act, RMCPs that are not customized, it's templates. You find a mention of Mpho Pty Ltd here, and wow, it was found from Fourie, BK, and all that. When you have conversations, whatever is in the RMCP is not implemented because this is not their own. They got it from a friend elsewhere. RMCPs that are not frequently reviewed or promptly reviewed. We've had of late inspections where the RMCPs haven't even taken into account the amendments that came into effect as a result of General Laws Amendment Act, or RMCPs are there not implemented. So those, that's what we're identifying in our inspections. The RMCPs are reflective of a rules-based approach and not necessarily a risk-based approach. And that we see it manifests in many different ways, where everybody's treated the same, whether you are an illegal entity or a politically exposed person or a foreign client, everybody's treated the same. RMCPs that yes, with regards to freezing requirement in respect of TFS, clients that have been sanctioned, RMCPs are deficient in how they're going to freeze or what is freezing within their business context. We have had an instance where a broker said, I will let know the product supplier that this client of mine is now listed, and it ends there. It might not be enough, because now you informing the product supplier, what are you going to do? The question would be, fine, you would have informed the product supplier, but what are you going to do? If that client then comes to you and says, I need to take up a new product, are you going to assist the client to take up a new product? Obviously, it needs to speak to the business operations where indeed you are handling or transactions, handling transactions on behalf of the customer. You might need to leverage some more. Freezing might, in my business context, would mean I'm not going to process anything that the client says in relation to investment account or whatever the case it is. But we need to see that. We need to understand that indeed how, when you freeze, what are you going to do? And then the other non-compliance that we are seeing is with regards to the governance obligation, where RMCPs are not approved or RMCPs are not implemented. And when we have conversations with the governance structure at the accountable institution, you can tell that the governance structure has no idea what they approved or what they signed to be effective. So it's a bit of a concern in that regard, Michele. So that's what I'd like to highlight now.
Okay, so there's definitely findings that relates to business risk assessments, to RMCPs. It is concerning that, with the time that's lapsed since the FIC Act was first amended in 2017, introducing this risk-based approach, having removed the internal rules and replaced that with the obligation to develop a risk management and compliance program, that we are still seeing this. So, okay, we see the findings. The question is now, when we identify the findings, what happens then?
Okay, so when we have identified the non-compliance, institutions will be afforded an opportunity to remediate those findings. And remediation is not by informing us that you've taken note of the finding and you will amend your RMCP accordingly, or you'll risk rate the client, or whatever the case it is. Remediation means you must give us evidence of remediating. If the non-compliance is you did not risk rate the client, we want to see how you risk rated that client. So you must give us evidence of risk rating the client. RMCP, if it's speaking to the issue was the provision was insufficient or deficient, you need to give us an RMCP that will clearly show us that you have addressed that deficiency. In cases where non-compliance is not remediated, we will take administrative sanctions against the accountable institution. And then my request to the institution is that if you have been inspected and there is a draft report that would have been issued to you, you will note that there will be preliminary findings on them, and for you to evidence that the preliminary or for the preliminary finding to not become a finding in the final report, you still need to give us evidence of remediation at that point in time. So don't wait for the final report when we are pronouncing that it's non-compliance and these are the findings. Between the draft report and the final report, you have that opportunity. It is important, I think I've already mentioned that in cases where there's non-compliance and it's material, we may take administrative sanction against the accountable institution. So accountable institutions, Michele, have proffered in the past that sanctions should not be issued because they would have then remediated subsequent to the inspection or subsequent to the especially subsequent to the inspection. What was the view of the FIC in response to these arguments?
Yeah, Mpho, I think it's quite significant. In the FIC Act Appeal Board, there were quite a few cases, some of them very recently published, where, like you say, the arguments have been made that, look, I agree I was non-compliant, but I have remediated all the findings. But the risk is low. Or, money wasn't actually laundered. A terrorist wasn't actually funded as a result of abuse of my business by a customer with ill intent. The view of the FIC Act Appeal Board, where these arguments were ventilated, was very recently in the Capital Point Properties matter, where the Appeal Board held that the fact that a transgression has been rectified does not mean that it was not a transgression and cannot or should not be subject to a sanction. So I think that very clearly refutes it. That's supported by the Volvo matter a couple months ago, where it was held that the fact that Volvo, so this was in relation to filing or failing to file reports with the Financial Intelligence Center. So the fact that Volvo remediated the reports after the first inspection is of no consequence when the sanction and penalties be considered, because the FIC Act punishes non-compliance. And that's why, we also said that's exactly what we do as a supervisory body. We're not coming to look for money laundering in your business. We're coming to see whether you comply with the FIC Act. And if you don't, it's clear from this matter that the FIC Act punishes non-compliance. And then, the argument proffered that, fine, I was non-compliant, but the risk was so low. That was refuted in the Parsons matter, where the appeal board held that the obligations on the appellant exist, irrespective of the risk rating of clients and products And this writing is not considered as a relevant factor under Section 45C2 of the FIC Act. So the fact that you have a low-risk product or you have low-risk clients does not absolve you from having an RMCP, having to actually identify your risks, even if the conclusion with proper rationale is that the risk is low, and to still keep your eye on the evolving nature of risk and the appropriate commensurate control and applying controls to that risk to mitigate it. So I think it's important to highlight those, as these are really recent, fairly recent cases, but it speaks to what has been profit. And I think it's good that we use the opportunity to not bust some myths, but, you know, make sure that people understand it. It's good that you remediate. You should remediate. That's ultimately the change in compliance behavior we're looking for, to see in terms of sustainability of that remediation. You ultimately, as a viewer, becoming in a better position every day to identify your risks and mitigate them. That's the ultimate goal. But certainly, if your non-compliance was for such a long period and so material, you know, it might cause and it might attract administrative sanctions, essentially. So with that being said, Mpho, in summary, we have looked at conducting a business risk assessment, doing a risk management compliance program, and the like. And you talked about the findings, but I think the viewers would appreciate if we can just help them a little bit in conclusion, to focus on what is it that we expect. So if you conduct an inspection, what is it that you would like to see?
Thanks, Michele. So as the FSCA, our expectation when we are conducting these inspections, we would like to have sight of the business risk assessment. We're expecting institutions to have conducted a business risk assessment that has been incorporated in the RMCP. That RMCP must be approved by the board or senior management or any other person that is exercising the highest level of authority in the accountable institution. The RMCP must be compliant with Section 42 of the FIC Act as it relates to MLTFPF risk, the rationale of risk rating, and the effective controls developed to mitigate the identified risk. That is very important. The RMCP must be implemented. It does not help to get there and find an approved RMCP that does not, or that is not implemented, or to have implemented something that hasn't been approved by the board or senior management. Staff needs to be trained on the RMCP. The business risk assessment, I think we've labored enough on the business risk assessment. It must be reviewed frequently. So in a nutshell, Michele, that's the expectation, whether we are coming for an inspection or not. But in an instance where we do or ask for information, then this should be correct, or this should be what the institution is going to provide us.
Okay.
Yeah.
So then there's guidance, Mpho. You and I are doing this webinar today for the absolute pleasure and learning delight of our viewers. But we're doing this because we know there is a need for assistance. I think you've come across it in your inspections probably as well, other supervisor engagements. People sometimes do feel overwhelmed. They're not sure where to start. They're not sure if what they have come up with is correct, because, you know, I think there's a perception still that what would satisfy us as a regulator, rather than what would answer the question, does the accountable institution understand the risk? Can they spot it? Can they mitigate it? That's actually the purpose of all this work that must go into this exercise. So we don't want to leave our viewers hanging. We do work in webinars, newsletters, We have other publications on our updated AML CFT page, such as the body of knowledge, the sectoral risk assessment, national risk assessments that you were referring to, that's so integral in considering when developing or conducting a business risk assessment. Those are all published there. As and when they are reviewed, renewed, new publications follow. So that is always something we can steer our accountable institutions to. And of course, then there's us, you and me, the rest of the team. We are waiting for the phones to ring. We want to help. We want to hear you out. We want to assist. Our contact details are, in fact, on the website, so no excuse not to phone or email us. And then, of course, there's assistance by the Financial Intelligence Center. One of their formal mandated functions is, of course, issuing formal guidance. And we have some new products to remind the viewers that are available. There's the Public Compliance Communication 59 on beneficial ownership, hot off the press. But certainly that helps to understand who is a beneficial owner, what must I do with a beneficial owner, and all of that speaks again to controls as well as interpretation of risk reflected in RMCPs and BRAs. There's guidance on implementation of targeted financial sanctions. Mpho, you specifically referred to that obligation to freeze without delay. What does it mean? If you're not a bank, you're a non-bank financial institution, you don't actually have someone's account, what does freezing mean for you? Should you keep records of the screening results, things like that? I think that can be very helpful for our viewers. And there's also this PCC 53, which has been developed as a guide to develop a risk management and compliance program specifically for DNFPPs. But the legal principles are absolutely the same. So I think it's a very useful document if you haven't started yet, you're new market entrant in the non-bank financial space, or you want to maybe compare what you have with what could be. It's not a template, but it's an extremely helpful piece of guidance to help. So again, there's many more. There's long lists of guidance. The Financial Action Task Force issues extremely robust and well-researched papers that can also give you a glimpse of, from an international perspective, what risk could look like, what it does look like, what people find. So we are here, we're committed to help with assistance. And in the wise words of the great man himself, it always seems impossible until it's done. So yes, it might seem like a very chewy toffee or a very high mountain today, but the moment you start to work on it and you delve into it, you will get more comfortable with even with the language of risks, threats, residual, all those fancy things. You're going to get more comfortable with it the more you use it. So with that, Mpho, from my side, thank you so much for sharing your expertise, your knowledge, your experience with our viewers. I'm sure they appreciate it. To our viewers, please watch this webinar as many times as you like. It's mahala. Share it with your colleagues. Comment on it. We would like to hear from you what we can do better, any topics that you propose we should tackle as well. But in the meantime, we wish you all the best in discovering your compliance successes and hopefully not many failures. And we hope to see you in various platforms soon to tackle more AML CFT discussions with you. Thank you.
Thank you.